Hey everybody, economic analyst here. I'm just giving you a little bit of a recap of what's been going on and transpiring in the markets the past week or two, as well as an update on a chart that I created that tracks the stock market performance in relation to GDP numbers and the 30-year Treasury rate, which, as I said in a previous video, is often looked at as the risk-free rate or the way of gauging the opportunity cost to owning stocks. So in the past several days, we're seeing a little bit of a rebound in the stock market. The Dow Jones is just about 1,000 points or so away from its all-time highs. Bitcoin is also having a little bit of a retracement. Now it's very much still off of its all-time highs of closing out at about 68,000 points, and it's down by nearly 40% from where it was when it reached its peak in November, as the onset of rising interest rates that have been going on for the past 3 months or so have chopped into Bitcoin and has also stemmed out the stock market from its record growth that we were seeing post-pandemic, or really on the tail end of the pandemic. I can't really say that we're post-pandemic yet, because there's no telling when we will be through these COVID cases completely. But with all of this going on, you might be wondering, okay, well, what's going to happen next? I see, in one of my previous videos, I told you, well, I expect markets to pull back and Bitcoin to drop. But is that always the case? Well, that's where I introduced this chart right here, which is the stock market valuation using the 30-year Treasury yield. Now, the orange line here is the way that I've used is I take the 5-year GDP growth rate, I divide that 5-year GDP growth rate by what the 30-year Treasury yield rate is, then multiply it by the current GDP numbers. And the blue line is the stock market capitalization, which is an adjustment based off of the Wilshire 5000. So originally in this chart I had the Wilshire 5000, but some time ago, I recognized that the Wilshire 5000 does not take into account the entire market capitalization. And indeed, when we look at the Buffett indicator on this, there has been a lot of work going into what the actual current market capitalization is. So in this article that was done by currentmarketvaluation.com, they talk about how that back in 1971, when the Wilshire 5000 index was originally created, a 1-point increase in the index corresponded to a $1 billion increase in U.S. market cap. So it was a 1-to-1 ratio, but that's no longer the case anymore. As of December 2013, that 1-point increase in the index is now corresponding to about a $1.15 billion increase. So there has been a little bit of a discoordination between the Wilshire 5000 index and the aggregate stock market capitalization. And the data is coming from Wilshire itself. So Wilshire is reporting on its own index and saying the index is no longer a perfect correspondence to take a look at market capitalization. So doing a linear regression and then just adjusting for that gives you what your actual stock market capitalization. Nevertheless, it correlates very strongly with 30-year Treasury rates. So it tells you that investors are paying attention to 3 things. One is the amount of income in our economy right now. 2 is what has been the past GDP growth. And 3 is where are the Treasury rates right now? Where's the 30-year Treasury rate? And they're balancing that out. Now, it doesn't always, link together. There have been times when market valuations have run higher than the actual market capitalization, so stock markets were lower priced than where they should be, which would be a good buying opportunity. If you bought the Wilshire 5000 back in 1977 and held it, you would have made a fortune. And there are times when the stock market capitalization was running hotter than the market valuation, such as in the infamous dot-com bubble. That would have been a signal to you that says, hey, maybe I should be selling my stocks. And if you sold your stocks at this time, you would have made off like a bandit, and you really wouldn't have missed out on any returns in the stock market for over 10 years. And then there are times when the market capitalization will plummet, such as the sudden bursting of a credit bubble, much like what we saw in 2007 and 2008, that will then follow suit with market valuations dropping. Okay, so it does not necessarily mean that the market capitalization has to run right in line with market valuations. But what this does mean is that based off of where interest rates are at right now and the GDP growth rate, the markets has probably peaked. Could it run hotter than the market valuation index? Yes. And what could be the factors? Well, there could be expectations that interest rates have shot up too much and there could be a pullback. Right now, I'm estimating this based off of an average 30-year Treasury rate over the course of 3 months at about 2.11%. Current 30 years about 2.23. If it continues to rise, that may bring up that average as time goes on, which would then in turn drop this valuation. But it could be that investors might expect that the 30-year Treasury rate has increased too much. Let's take a look at what was going on, a year and a half ago, or really about a year and 3/4 ago. The 30-year Treasury rate was at 1.4. Now it's at 2.1. Maybe some investors say that's too high given current conditions and Fed monetary stimulus. I'll bet that the rates will pull back a little bit, which will be a buying opportunity for stocks. It could be that they're expecting stronger GDP growth than what I'm pricing in right now. So I'm pricing in, based off of the GDP now cast, a weak growth of the first quarter of 2022 of 0.7%. Now, as a frame of reference, the GDP nowcast tends to be more often than not fairly accurate. At the end of quarter 4 2021, GDP nowcast was saying that the annualized growth rate would be 6.5%. We got 6.9. They're calling a very weak growth right now of 0.7%. This is a real GDP number, not a nominal. So backing out the GDP price deflator, which is more of an art than it is a science, and then taking that historical growth trend, it seems that, we'll probably have a nominal growth rate of every quarter of about 2.5% on an annualized basis. But investors may be becoming increasingly bullish. They may say, well, the GDP numbers were really strong in 2021, and therefore we're not pricing that in appropriately, and it could just be plain greed. But absent all of that and pricing in a rising interest rate environment, markets have probably peaked. Okay, the market valuation is peaking right now. By this estimate, it looks like that, we might see the Wilshire peak, have a little bit of a jump in 2022 second quarter, maybe up to about 50,000 points, and then a slight pullback. Now, this is assuming that we only get a 0.2% increase quarter over quarter in the 30-year Treasury rates. Well, 30-year Treasury rates have already jumped by 0.3% in just a little bit over a month since the end of the fourth quarter. And again, we're taking the average there, but the results are speaking for itself. If that jump continues as markets are running ahead of Fed policy, then we might see a stronger pullback. What, for instance, do we say that we don't see a 0.2% increase every quarter? What if it's 0.4? Well, if it's 0.4, we're going to see the market valuation do this, and we're going to see that the market capitalization will drop down to about 40,000 points, which is indicative of a Wilshire 5000 index of around, say, 35,000 points. To put that in perspective, that would be the equivalent of a Dow Jones Industrial Average of under 30,000, and it would be a more than 20% drop, up maybe upward to a 25% drop in the stock market. Now, do I see that transpiring? I don't really know. It could be, but to give you the conservative estimate, we're looking at least a flatlining in stocks. So there could be some volatility that transpires in 2021 and 2022. It really just depends on how aggressive the Fed is going to be about its monetary policy behavior in 2022. And we're already seeing articles come out, such as by Bank of America, where Bank of America is coming out and saying, well, the Fed's not really going to hike rates 4 times this year. They're actually going to do it 7 times. So the Bank of America is saying, starting in March, guys, that we're expecting the Fed to hike interest rates by 1/4 of a point every 6 weeks. Do I think that's a little bit too hawkish? Yes. What am I expecting? 4 rate hikes. 1 in March, 1 in June, one in September, and the last one in December. But the Bank of America is not the only one that's talking about this. There have been others that have been calling for multiple rate hikes in addition to 4 rate hikes, not just Bank of America. But do I think that they're being a little bit hawkish? Yes. The ultimate thing that I'm trying to drive home here is that we really don't know what the Fed's going to do here. The Fed's making a huge talk about how they're going to turn and pivot to hawkishness. So there have been some investment firms and banks like Bank of America and Morgan Stanley and such. They're saying, I don't think it's going to be 4 rate hikes. I think it's going to be more than 4 rate hikes. And most certainly, if we do see 7 rate hikes, which I haven't seen any forecasters calling for more than that, we might see a 0.4% jump in the 30-year treasuries, especially as markets take the hit by that. On the other hand, what happens if, say, we enter a liquidity shortage, much like what we saw in 2019, and the Fed decides to lower interest rates back down, to try to stimulate that and say inflation be damned? We have to shore up the banks again. We have to shore up those balance sheets. We could see a reversal of this. So personally speaking, I'm thinking that we're going to have 4 rate hikes, and given the penchant of foreign investment inside the United States, buying corporate bonds, buying government bonds, I would expect that government bonds will be dragged slowly upward over time. Now, we could see some jumps here and there. We saw some jumps in the 30-year treasury rate most certainly back in the height of the pandemic in middle of 2021 when inflation really started to spike up, but then the Fed said it was transitory, so the 30-year kind of abated. But now, with the Fed admitting that inflation is more persistent than what they thought, and we're going to find out tomorrow just how persistent this inflation is, this is really going to be a dictating term on where the 30-year is headed here. So there's a lot to digest here. So, but the point that I want to drive home, the main thing I want the takeaway for this is more than likely stocks and Bitcoin by default, since Bitcoin runs in tandem with the stock market in relation to interest rates, have peaked. Now, let me take a moment to talk about Bitcoin right quick. When I say that Bitcoin has peaked, I'm not saying that Bitcoin has peaked at $44,000 per coin, even though that's incredibly high. I'm saying that Bitcoin has peaked from its $68,000 price. So we're seeing a little bit of a retracement in Bitcoin. And quite frankly, we could see more of a retracement. We could see Bitcoin get back up over, say, $50,000 a coin. Maybe it will, maybe it won't. I do think tomorrow is going to be a pressing term depending on how hot the inflation numbers are coming out. But yeah, if we do get, we might see a bounce back in the coin itself. Some bulls will call this and say this is going to be the reemergence of the Bitcoin bull market. But again, we're in that rising interest rate environment. So absent of accommodative monetary policy, unlikely. Very, very unlikely for Bitcoin. More than likely it will stay subpar to this high of $69,000. I really don't even expect it to breach $60,000 again. And then as time goes on, it will be dragged down. It's really impossible to value Bitcoin because it's such a speculative asset and there's not enough data history on it. But with the stock market valuation, I feel a lot more confident in calling the peak. Again, this doesn't mean it's set in stone because we've had periods of time, we've had 3 periods of time in the last 25 years where markets have run hotter than the valuation assuming GDP growth and the 30-year treasury rate. And again, that's basically market greed. They may be expecting the GDP numbers to be hotter than what they really turn out to be. They may expect interest rates to be lower than what they turn out to be. Could be a mixture of both in there. But this is certainly, given the strong correlation between the stock market and using the 30-year treasury rate combined with GDP growth, this seems to be what markets are really using as sort of a backhand calculation of what to buy and what to hold and what to sell on an aggregate basis. It seems to be the big driver of investment behavior, and indeed, if I'm right about this, then the rising interest rate environment is going to quell that and cause at least a flattening out and a peaking or plateauing of the stock market. We'll see as time goes on. And again, I'll give you these updates periodically on what I think is transpiring here. In the meantime, we're seeing a little bit of a bounce back in gold and silver. But as I've said before, just because we've seen that bounce back in these markets does not mean that this is going to be the new bull market run or anything. I mean, when we take a look at gold to where its real high was of over $2,000 an ounce, until we see gold break cleanly that $2,000 an ounce, the bull market's not really here. It's going to be trading in this channel of roughly between 1,800 and 2,000, may even some dips down to 1,700 here and there. Similar story as with silver. When silver peaked out, it never could really break away cleanly above this $28 an ounce. And it's been trading between that and about 22 to 23. So until it breaks cleanly above that $28 an ounce, this is not going to be a real bull market for silver. Again, what's going on in these investment markets? They're waiting for the shift. They're waiting for investors shifting in behavior, and the interest rates could be the catalyst, coupled with rising inflation. Now, if we start seeing rising interest rates with falling inflation, that can definitely throw a monkey wrench into this haywire and cause more of a deflationary pattern to manifest, not only in the stock market, but also in precious metals. Now, how would a deflationary system act in precious metals? Well, based off the money supply growth, and I've talked about this in other videos, and I'll revisit later, it will probably mean that it will be more of a stagnation, much like what we're seeing now in precious metals. Gold will probably drop to about, say, $1,700 an ounce. Silver will probably drop to, say, around $20 an ounce at the lowest here and there, and then just pile around there as the money supply slowly increases and drags those prices up. But it wouldn't be a real full-fledged bull market like what many analysts are expecting, where we could see some 20-25% double-digit returns on gold and silver this year. Now, what am I personally thinking? Well, given the stock market's performance right now, and if the interest rates are slowly increasing, this flattening out in the stock market probably means that there's not going to be much growth to gold and silver, maybe a little bit of an uptick. Best guess on that matter is that gold will probably jump up to around $1,900 an ounce to $2,000 an ounce by the end of the year. Silver will probably end up over $25 an ounce, maybe test that $28 ounce ceiling, but I don't expect a clean break. But if we start seeing a more aggressive Fed being panicked about inflation, as Bank of America predicts, or we start seeing investors panicking about the negative interest rates and the systemic losses, and we start seeing a real correction in the stock market of, say, greater than 10 to 15%, yeah, this could be the hallmark sign that we're expecting, where the bull market for precious metals is beginning, and we're going to see that run up into precious metals before the bursting of the credit markets caused by a deterioration in the credit markets from a lack of liquidity able to function to purchase and pay off debt. That will then cause a systemic drop in the precious metals, at least on a nominal term basis temporarily, before we see what the Fed assesses on that matter. Guys, that's all that I have for this video. If you like the content that I produce, make sure you drop that like button. Click that like button. Subscribe to my channel if you haven't already. Click that notification bell. Share this video with your friends and whoever you think has an interest in this. It's time to get the word out. We're definitely in dangerous times right now. Interesting times, but certainly dangerous times for the market as we see a paradigm shift in the investments. Guys, if you have any questions, make sure you just leave a comment. Let me know what you think about all of this. If I've missed something in my analysis, I would love to hear from you. Again, I'm in the business of sharing information as well as having information being shared with me. And, more than anything, as time goes on and I see some more trends opening up, I'll definitely try to relay that and give you guys that latest information to keep you ahead of the curve that's going on right now. Once again, guys, I thank you for watching this video, and I'll talk to you next time.